Welcome, Heather, and thanks very much for joining us today. It's very good to have you with us. I wonder if we could kick off with a bit about your background and your role in Black Creek.
Pleasure to be here, and yeah, absolutely. So I've been in the investment industry, researching and analyzing global companies for over 30 years. I've had the pleasure of being at Black Creek for a decade now, working with Bill on the Alliance Trust strategy and our core global strategy here. We have known each other since 1994 and have worked together on and off over the last 20 years. So I think it's a very strong partnership and has resulted in long-term outperformance for the strategy.
And as far as the Alliance Trust portfolio is concerned, Black Creek runs a concentrated global portfolio of up to 20 companies. And you're looking at them from a 10-year perspective. So could you tell me a little bit about what kind of characteristics you're looking for within those companies?
Yes, happy to. So the strategy and our philosophy is very much focused on cash flows of the business. So we do view companies over a 10-year period, which obviously incorporates many different economic cycles. So we do incorporate recessions in our forecasts, but importantly, the philosophy resides around winning businesses. And what we're trying to identify are companies that really embed themselves in terms of their clients by solving problems and challenges and creating solutions for those customers and clients. These are companies that we believe are taking market share because of that uniqueness of their product or service. They are investing for the future, which means they aren't milking the business. They are reinvesting strongly in research and development, distribution, market expansion, new products and services. And this allows them to have a reasonable return on capital, but not excessive. And in most cases, the businesses are under earning because they are reinvesting so strongly. This then allows them to continue to gain that market share and create somewhat of a virtuous circle because of that uniqueness and their ability to continue to invest and take share. These are companies that also have very strong future potential growth because of that investment. And we believe that the management teams running these companies are also a key element. So we do spend a lot of time interviewing managements, and we look for strong, competent, honest, shareholder-friendly management teams.
And what about valuations? I know you look for companies that are mispriced, but would you consider yourselves to be full-blooded contrarians?
Contrarian is an aspect of our discipline. So we do tend to focus on companies and segments of the market that are underappreciated. We would view ourselves as really active managers, obviously running very concentrated portfolios. We're seeking to identify those global best ideas that are currently served up to us. That is the real nature of what we're trying to do. Contrarian aspects and contrarian segments of the market tend to create opportunity for us. And many of our greatest successes over long periods of time have been those companies that are substantially out of favor for whatever reason. We are taking a much longer term view. So in many cases, kind of view time arbitrage. We may enter a company or a business that is currently investing heavily for the future, or is going through a software upgrade or a management upgrade, when other managers might be more inclined to wait and see. We are much more interested in the long term of the business and the success that they're creating.
Could you say something about how the portfolio has performed, both in relative terms and absolute terms, over the past couple of years since the pandemic, and also how it did last year?
Yes, well, we've seen an incredible, really unprecedented amount of volatility in the markets, and a real tug of war between growth and value. Interest rates have certainly had a very, very strong impact in the last year, with central bankers substantially increasing interest rates and monetary stimulus that being taken away that was put in place during the pandemic. We are seeing value and valuations becoming much more important, which has had a very positive impact on our strategy and the Alliance Trust portfolio. So on a year-to-date basis, the portfolio has year-to-date ending December 31st of 2022, we've seen the portfolio add pretty substantial value relative to its benchmark. So it is down less than 1% overall, and it has outperformed its benchmark by over 700 basis points.
So why has the strategy not actually done better over the past year, given that there has been this big rotation out of growth and into value?
As I mentioned, it's been a real tug of war, mainly driven by previous central bank policies, significant stimulus, very low interest rates, negative rates in some parts of the world, which has really created a lot of speculation. We've seen a very narrowness in the market, particularly driven by US technology. Very few names made up a very substantial segment of the market, where we have not been positioned, certainly from the standpoint of valuation being a concern for us. We thought these companies in many ways were priced to perfection. We've also seen a significant amount of speculation in the area of things like profitless technology companies, the area of SPACs even, where you've seen a lot of profitless companies do very, very well. So very high levels of speculation on the growth side that led to a substantial segment of the market doing very, very well. And for us, we were not positioned there. Having said that, when we see these valuations become more meaningful and interest rates and monetary stimulus being taken away, interest rates increased, we have seen a very nice outperformance of the strategy. So over the last 3 years, we've actually seen the strategy significantly outperform, and a lot of that has taken place because of this tug of war between growth and value. So over the 3-year period, actually ending in December of 2022, the strategy has returned over 32% and over 900 basis points in excess of its benchmark. Having said that, you're correct. Value in some ways has done well. We do not own any energy companies, which has been the single largest segment of the market that has outperformed over the last year in particular. And that is one segment that we've not had as strong performance as some of the other value managers.
Presumably, though, the rotation has thrown up various opportunities in terms of valuations becoming a lot more attractive in the kind of companies that you are looking for. I wonder if you could say something about the kind of companies you've been able to pick up over the last few months, last year or so?
Yeah, great question. We actually have always viewed volatility as opportunity for us. And we've really seen that in the last 18 months or so because of that immense amount of volatility we've seen back and forth in the market. So, what we have witnessed in the last 18 months is a substantial decline in many high growth businesses. So, that has enabled us to pick up new names that are more, in our minds, have stronger organic growth potential than what previously existed. So if you were to ask what the portfolio internal rates of return look like when we rank them, we would say over the last 18 months, we have been able to substantially upgrade the portfolio with new companies, new businesses that have a stronger organic growth potential within those companies, an ability to offset inflation, maintain strong margins and cash flows. And we've actually got now, when we look at the portfolio, a more attractive IRR, internal rate of return, for the companies and the portfolio overall than what we would have had 18 months to 2 years ago. And so we feel very strongly the portfolio has been upgraded in this more turbulent market environment with companies that we think offer better growth prospects and profitability and cash flows in the future.
Could you give an example of those kind of companies or sectors that you've been finding them in?
Yes. So one couple of companies that we've been able to pick up have substantially declined over the last 18 months or 2 years. And Zebra is a digital leader in automation, identification, and data capture technology. It is a leader in the area of retail, logistics, as well as a new market segment for them, which we're quite optimistic about, is their healthcare technology. So we've all gone through a substantial pandemic. We hear about shortages of nursing and qualified individuals in hospitals and nursing care. Automation is a way in which we can improve upon this healthcare system, and we think Zebra's technology and digitization will help substantially in this area. Another example would be a Swiss-based company called Kuehne + Nagel. Kuehne + Nagel is a leader in freight forwarding and asset-light logistics. They are at the forefront of being able to track technology and help their customers and their clients actually with things like nearshoring of technology, which we're seeing with greater geopolitical unrest. We are seeing a lot of improvement and rethinking of manufacturing footprints. And we do believe that Kuehne + Nagel will be a substantial beneficiary of those trends with very complex logistics and software. They have they are a leader in Pan-Asia. They also are very, very strong in sea freight and air freight, which makes them unique, and very strong management team, excellent governance, and actually have a net cash balance sheet. So very, very strong upgrade, we believe, to the portfolio.
Continuing rampant inflation and rising interest rates are obviously a big problem for most of the developed world at present. Can you tell us something about how the companies that you're investing in are impacted by those trends?
Yes, most definitely inflation has not been transitory as some central bankers initially believed. And at some point, many of the interest rate levels were unsustainable. So we are seeing multi-year inflationary pressures around most regions. And what we are starting also to see is this work their way into labor costs. This will make inflation much longer term, because inflation, when it hits the labor market, is far less transient and has much greater impact. So where we have focused, once again, are on these winning businesses that have that unique product or service that they can price for the inflationary pressures that they are seeing. So if it is a human capital business, we want it to be a company that has the ability to price for that human capital. If it's software and services, the same idea. We are seeing some businesses increase pricing substantially, and we're focusing closely on what that means from a unit labor perspective, as well as their ability to maintain their margin structure. We believe because they are winning businesses and they have unique products and services, they are able to increase pricing in line with inflation, and it have minimal impact on their actual top line growth with respect to downsizing and seeing a massive decline in their actual organic growth rates. So we think the companies are uniquely positioned because they have that very strong embedded nature with their customers and their clients, and are able to offset these inflationary pressures.
Could I ask you about ESG, environmental, social, governance considerations? How important is ESG when you're selecting companies?
ESG has always been embedded as a very important aspect of our investment process here at Black Creek, and increasingly so over the last five plus years. We've come a long way in terms of our documentation and our processes that have been put in place. We tend to view our process as driving societal progress through investment, and a strong respect for finite resources from our management teams. Governance has been embedded in the process from the very beginning of our philosophy, which dates back over 3 decades. We strongly believe that governance then results in positive environmental and social changes. But it has to come from that strong governance of the management teams and the boards. We've always had a responsible investing policy, which is open to our clients to view. We do review that on an annual basis and update it accordingly, given the evolving nature of ESG. We vote our own proxies, and we engage with our management teams. We've got over 115 documented engagements on our strategy over the last 3 years. We've done a net zero roadmap, which is important to follow our company's progress on carbon. And we also have extensive amount of carbon footprint information on all of our companies and the portfolio in totality. So it's really embedded in the process, and when we do find a new business, a new idea that makes its way into the portfolio, we do a stringent sustainability analysis of that company with their own sustainability information, as well as outside information from the MSCI network as well.
Are there particular sectors or companies that you would avoid altogether then, or do you tend to take very much a best-in-class approach?
We tend to view ourselves as not taking an exclusionary view. You lose your ability to engage and drive change with that type of exclusionary view. Having said that, we are very focused on improving companies. So not necessarily companies that tend to be absolute best in class with little room for improvement, although we do have many AAA rated companies that have very strong carbon disclosure rankings, as well as all of the external rankings as well. Companies like Schneider Electric that have been a leader and a real trailblazer in the ESG space for many decades. We also have companies like Heidelberg Cement, which is a great example of a company that has a very strong carbon footprint. But having said that, they are working on many carbon capture projects, which we think will drive substantial change to the cement and materials industry going forward, aggregates as well.
Could you give me an example of a company that you have bought in recent years that didn't work out?
We all know we're not perfect. The strategy is not always perfect. One example would be Hain Celestial, which is a US-based, although they have more of a global footprint, US-based leader in better for you and organic products. They really were a pioneer in this area. Obviously, now that we've gone through a pandemic and still are in many ways recovering from it, many of us are much more focused on eating better, taking care of ourselves, focused on minimal ingredients, so not a lot of packaged food. This was a company that really started that trend in the 80s, and through many acquisitions became a leader in organic baby foods and plant-based products, minimal ingredient products. They have a very strong footprint in the US and also in the UK market. What we underestimated, very strong belief in a new management team that was taking over there and a strong board. Where we underestimated were just the particularly challenging periods of inflation and being impacted by consumers, particularly in the UK, trading down because of the inflationary pressures in this space. We believe that the trends to healthy eating remain and limited ingredients remain, but the margin structure of the company, given this trading down and given their focus on organic and higher priced products, led us to reevaluate the IRR, and it no longer placed in our top 20 names, so therefore was eliminated from the Alliance Trust portfolio.
And finally, could you give me a bit of information about one of your favourite stocks and why it has done so well for the portfolio?
Probably one of our most successful names in the last 3 years or so has been a company by the name of Interpublic Group. And the Interpublic Group is a leader in, again, that digitization trend. They are a leader in automation and digitization of helping their customers and their clients understand their media and advertising budgets. So many of us obviously consume advertising and media on a daily basis, but if you think about the digitization and how that's influenced that segment, you can have an advertisement change on a billboard within seconds. So lots of better understanding of how companies are investing for the future and building their brands. So this is a business that we have focused on and a segment we've focused on for many decades. What makes Interpublic unique is their open architecture within their media brands and media teams. So they have really the goal of helping the customer and the client from whichever angle they can do that. They purchased a software business called Axiom several years ago, and this brought them many data scientists that allowed their customers and clients to have a far better understanding of their return on investment for advertising. They have some of the best talent in the industry. They've been able to outgrow their peer groups consistently year after year. And this is a business that when we purchased it was very much a contrarian idea, because there was belief that digitization was going to be the death of kind of old media, and that the Googles and the Facebooks and so forth were going to take over in terms of digitization. And in actuality, what has happened is companies like Interpublic Group continue to gain share because they have that ability to really demonstrate return on investment for their customers and their clients. They also have about 28% of their revenues in healthcare, which continues to demonstrate very strong above industry growth. And they have unique talent in that area that has enabled them to outgrow their peers for the last 5 years. We purchased Interpublic Group and substantially added to this name during the COVID period, when it traded as low as $14 US, and today it trades at over 35. So it's been one of our strongest returns and remains today one of our strongest IRRs.
Thank you so much for joining us, Heather. It has been an extremely interesting chat, and I feel as though I've learned a lot, so many thanks.
Pleasure to be here, and best of luck to everyone in 2023.